All right, we're loading up on Facebook. We're almost there. And here we are, live with Tuesdays with Terry, Real Estate Talk. Tonight, our guest is Dan Finn, the founder and namesake of the Finn Financial Group in Newport Beach, California. Dan's been in the business for about 30 years. His firm is a specialty planning firm. They're full service, but they really specialize in structured settlements. I am going to tonight. We're going to discuss what structured installment sales are. And we're particularly interested in real estate, but this also applies to your business. Maybe it's time to to move on to the next phase of your life, and you want to sell your business. But as with people purchasing real estate, you might be facing some capital gains taxes. So I'm going to thanks for being with us tonight, Dan. And I'm going to let Dan talk a little bit about initially what a structured installment sale is.
Great, thanks, Terry. Thanks for having me. Appreciate the chance to talk to you and your audience today. Certainly a topic that's always in the news is taxes. Are taxes going up or taxes going down? Nobody really wants to pay them, even though everybody does, or most people do. We are here to talk today about what you can do when you run into some that you don't have to pay, and hopefully show your audience ways that they can avoid them in situations where it makes sense. In anticipation of this, what I did, I thought it'd be nice if I actually teach classes on this. I have a full-blown webinars that I do for realtors, title companies, lawyers, and I've done this for a long time. And what I've done for this session today, I've kind of cut that down a little bit and just got the high points, and I'm going to go through that with you if you don't mind. You did tee up something that was really important, though, is you mentioned I'm a structured settlement expert, and that is what I've been primarily for 30 years. But along the way, what we were doing with personal physical injury victims to help them manage their injury settlements kind of morphed into taxable situations. And One Life Company a number of years ago did some investigation and research and discovered there's actually an application for what we do in the real estate world. So this overlaps into what you do. It's not widely known, not widely understood, and that's what I'm doing my best to try to change this. So if it's okay with you, maybe, and stop anywhere along the way, I'll just kind of get into my presentation that I use, and we'll take it from there.
Take it away.
Hopefully everybody can see this. Terry mentioned already, but just by way of background, I have been at this for quite some time. Have mostly been spending a lot of time focused on helping people get there. I hope this is the right one. This is the wrong one. Let me get the right one here. Let's see, screen shading has stopped. This is, where did I go? I knew I'd do that. Your agency, Terry, keep talking, I'll find it.
Well, I had never heard of this before until I think it was last year sometime. I read one of your articles on LinkedIn. You wrote it for an organization, a trade paper, and that's when I was first exposed to this, the whole settlement field. And what's interesting now is real estate prices are so high that some sellers are actually realizing some large profits from the sale of their house. And I'm no tax expert, but they might not have any of these your first time sale, you're over 62 or something, and you can avoid the capital gains tax, this might be this could be a real issue for you.
Okay, excuse the hiccup there, everybody. That was the beauty of live theater, as Terry and his TAPS group understand. Sometimes things don't always work tech week the way they should. Back to where I was before. I have been at this for a while. Throughout that time, whatever I've been doing, my entire focus has been helping people secure their futures with fixed term solutions, either on a tax-free or tax advantage basis. And thanks again, Terry, for having me be here today. We're talking about this being a solution to capital gains challenges. And by way of background, the section of the tax code that says you can do this is the Internal Revenue Code section 453. 453 says in part that anytime you dispose of a property where at least one payment is received after the close of the taxable year is a structured sale. So you could, if you sold a property, I could sell you a property and you say, okay, I'll buy it from you. I'll give you half of the money here in November, and I'll give you the other half in January. And that will be our agreement, and you'll receive that over time. So you've had it over 2 years. You're going to get taxed in the 2 different years. That's how that's structured, how an installment sale generally works. They defer to the capital gains. When you defer income into a future year, you're also deferring the gains into the year in which you receive the funds. Without what I do, most of these installment sales historically have been the buyer and seller agreeing to terms. So maybe the buyer doesn't have enough money up front. So they pay enough money and say, I'll pay you this up front, and I'll agree to pay you this over time. That's great for the seller because the seller gets the tax deferral. They may pay overall lower taxes. They may not pay any taxes if it's done right. But the risk there is they're dependent on the buyer to make these future payments. That's a huge risk. If the market changes, the buyer becomes insolvent, the buyer walks away from it, the buyer turns it into a meth lab, whatever. You might get the property back, but you don't want the property back. You get all the headaches that come with it and the tax problems as well. So the solution was that one of the life companies we used to work with in 2004 developed this. They have since left the market, not just this market, but the entire fixed instrument marketplace for life insurance. But fortunately, we do have options today in 2019. They went away after the Great Recession, equity disappeared, people weren't selling businesses, we had a lot of problems. Now, of course, property values are up, people are happy to sell for large increases in the value of their properties, but they don't really like the taxes that accompany them. So 2 life markets came into the world and started working. And one of them's a very household name. Anybody, you've never watched TV or watched a football game that you didn't find out about who MetLife is. They've been in business since just after the Civil War, have been making their payments consistently through that time. One of the largest financial services companies in the United States, North America, and the world. So they're in this. That's a very nice plus. Company you haven't heard of, Independent Life, actually down there in Florida near you, is where they hang their hats. Texas and Florida, a lot of their marketing folks are in Florida, but they are also in the market. They're a newer life company. They came into this business just to do this type of thing. So they are eager to work in some of the space. And they have some flexibility that Met doesn't allow. So having both of these options together is a terrific option for the sellers who want to defer capital gains. You can also do ones that are funded by US Treasuries. Okay, I'm kind of talking around things yet to actually seeing, so your viewers can't really see what happens. Hopefully we'll change that in these next couple slides. Anytime you sell a property, or a business for that matter, and you have these capital gains, you're going to have to pay taxes on those gains. If it's a personal primary residence, as you know, and your firm knows, if you have a personal residence, you get to exempt 250 if you're single, or 500,000 in gains every 2 years if it's your primary residence. So a lot of people move into their rental properties over a series of years, stay there for 2 years, and work around it that way. Not everybody can do that. I'm going to show, this is a 2-minute, less than 2-minute video. It's a very highly produced, highly effective cartoon video, promotional video that I think does an excellent job of explaining what this is and how it works for you. This is produced by MetLife. I'm really happy that we have this to show people. So I'm going to shut up for a minute, put this on. Hopefully everybody can hear it.
How can a structured installment sale benefit someone who's selling a property or business? Meet Joan. She's a successful entrepreneur who invested most of her earnings into investment properties. Joan knows one of her properties has significantly risen in value, appraising for $2.5 million. She decides to sell this property. As she puts her home on the market, Joan consults her legal and tax advisors. They present her with 2 options. Joan can receive the proceeds from the sale in one lump sum, but that would expose her to a huge tax bill today. Or Joan can choose a structured installment sale. She chooses this option for 2 important reasons: tax efficiency and guaranteed income streams. Joan can reduce her capital gains taxes and reduce net investment taxes as well as state taxes for a huge savings. Joan's proceeds will be structured to provide her with a steady stream of income for a period of 20 years, securing her financial future. Structured installment sale, a tax-efficient solution for property and business sales.
Okay, I'm going to pause a minute, Terry, tee that up for you. You know, you being down there in Florida, you've probably seen it a lot. When the hurricane comes through, takes the value of properties and condos down significantly. Some people come in, buy them at a depreciated dollar figure. Time goes by, and now those properties are significantly appreciated. And I don't think it's probably unreasonable to think there are people in a very small circle from where your office is that probably bought places for $300,000, and they're probably selling them now for in the millions, depending on how long ago they bought them. We're seeing that all over here in California. I've talked with people all over the country, and we know that this is happening.
Yeah, well, especially when we had the crash, the Great Recession.
Right.
The values dropped, and people that held onto the properties and made the payments all this time they're reaping the benefits now. Right.
Yeah, and that's good. And now those folks, some of those folks might be saying they might be of the age where they're saying, okay, there's probably going to be a market downturn at some point, and maybe I should get out now. Getting out now might be good, but if they got to get tagged for big taxes, it's less attractive. So let's just take an example of somebody. Say there's $1 million price tag. Could be a condo, could be a single family residence that's a rental property. And this was bought long ago for $100,000. So $900,000 appreciation is taxed as capital gains, right? So what kind of taxes do they have to pay on that? 2021 depends on your filing status, single or married filing jointly. Depending on what the value is that your gain is, you're going to pay 0, 15, or 20% tax at the federal level. So that example that I just showed you, you know that at least probably close to half of it's going to be taxed at 20%. There might be a little piece that they don't pay taxes on. Some gets at 15, but most of it's going to be taxed at 20%. This, by the way, does not include state and local taxes. I think Florida is better than California. Out here we have capital gains taxes that are about 13%, plus net investment income tax of 3.8% if the taxpayer's AGI exceeds $200,000 or $250,000. So you start to imagine a cash lump sum these are the tax brackets that the homeowners are going to fall into, or the investors are going to fall into. So now, to break that particular example down, let's imagine on the left-hand side here is a cash sale. I have, hopefully you can see this arrow running around here. We had $1 million. So you sell it for $1 million. You bought it for 100. You don't have to pay any tax on that. Your gain is 900,000. All of that's capital gain. So you're going to be taxed this year. This is 2021 when this transaction occurred. This is going to be taxed all as capital gain. If, on the other hand, you talked to somebody, said, well, talk to me about that structured installment sale thing. What does that look like? What if we broke that $1 million into a series of 10, and I've got 3 of them here, but imagine there's 10 all the way out to the right, 10 $100,000, 10 plus 90, that's $100,000, plus a little bit of interest that's earned through the annuity. So each year, the individual receives their 100,000, which is the $1 million divided by 10, plus almost $3,500. And this number might be different today. I don't know. When I ran this, that's what it was. So now they're only receiving basically $104,000 every year. You remember that tax chart that I showed before, you're definitely going to be just barely into the 15% if you're married filing jointly, and you're eliminating the 3.8% net investment income tax. So immediately you've got 8.8% income, 8.8% tax that's just gone out the door. You still pay tax on the cash lump sum. You still pay tax on the installment sale, but your tax obligation is much smaller. And if you ran 10 of these across and you compared this tax here on the left with all 10 of these, you'd find that the tax you pay is a small percentage of what this big tax is on a cash lump sum transaction. So that puts the seller in a much happier position. And that's kind of the long and the short of it. I like to make sure that I mention that somewhere along the way, that what always ends up getting lost in the translation, we always get calls afterwards, maybe a week after I do some of these things, and say, well, I've got somebody, they've got a buyer, but they only have, they can only come up with about 60% of the funding, and they need some help with the financing. We do not do financing. This is not financing. The buyer still has to come up with the cash for the property or get a mortgage, whatever they normally do for cash. The only difference is how it's paid out. The buyer has to be involved in this transaction because of the way the tax code is written. You can't do this in a vacuum, and you can't do it without them. We have to arrange this purchase so that the buyer says, I am buying this for this price, and as part of this price, we're going to take a portion of this and we're going to use this to finance, or to set that aside to a third-party assignee who's going to arrange to have these payments made to the seller in the future. That's how the seller gets the tax deferral. That's how the buyer is able to remain part. That's why the buyer has to remain part of that transaction. Buyer still has to be involved. That's why when we recommend people discuss this. Now, this is a seller's market. I read not long ago where there's a seller that just said, that I didn't read the whole article, but they said they're getting offers of $1 million over the asking price. And somebody in the asking price is offering Bitcoin that they bought a long time ago in addition to that. So all kinds of incentives that the buyer is incentivized to get properties that they want. The seller's in a strong position to be able to demand this if they let it be known up front. Where these fall apart is when they wait too long. They wait till the end. They get the final transaction. They agree to the price. They're working their way through to escrow, and then all of a sudden they start doing the calculations. And they say, "Wow, I'm going to get killed on taxes. I don't want to do a 1031 exchange. I just want to defer the taxes. Can I do that?" Yes, we can help them, but the buyer has to be involved. and both parties have to execute an agreement that acknowledges that this is a 453 qualified installment sale transaction. Some other buyer and seller pre-sale forms may also be required. And that is I know we're kind of got a limited time here. Like I said, those are excerpts from a broader presentation I do from people who get into this all the time. Like maybe if you ever had a realtor group, or there are bankers out there that want to hear more about the kind of the inside baseball of it, we're happy to go over it. But I don't think for most general people, kind of their eyes glaze over when we get any deeper into it than that. So I designed this specifically for your group and hope that it had some kind of meaning. I'm happy to take any questions from you, Terry, or I don't know anybody else that has any. If you're, I guess they don't take questions live, but why don't you be the question asker at this point?
What I am going to do is I'm going to post your contact information, because as you said before, I mean, everybody's situation is different. So if they're considering this, they need to have a conversation with you personally. But I'd also like to add, though, that there is talk of eliminating the 1031 exchange.
Really?
And, yes.
I hadn't heard that.
Yeah, and I don't know whether it'll happen or not, but that could be a bargaining chip in Congress right now. But the current administration would like to see an increase in capital gains, and they would like to see a change in the 1031. I think, historically, what you've seen is, and when we talk about taxes, is those who make the most money have the ability to pay the least amount of taxes. And it's because they search out these things, and they can get complicated. Let me ask you this: is there a minimum?
I think it's a good question. Most of these we see are in 500,000 and above, but they're less than that. I'd say probably 100,000 is probably going to be about the minimum. I can share with you an interesting story of somebody in California just late last year that did one of these. A couple inherited a property from, I don't remember if it was their father, mother, another relative, but he and his two siblings were each receiving a share of the property. And we're going to have to pay capital gains on it. And I think the net was roughly, say, $250,000 a piece. Well, the two sisters wanted to just keep theirs, but this guy's situation was unique. He was actually tied to a point where he was at a point in his life where they had a young child, and his wife was making about $40,000 a year. And they said, we could maybe just use this money. I could stay home and just, I'll have to work for a few years. You keep working at your job. We'll take this money and I'll just keep it until I have to go back to work, at least maybe till she's in school. So we ran some of the numbers and found out that by doing it this way, they were able to spread out this money over, I think it was like 6 years, with $250,000. So 250 spread out over 6 years, plus a little bit of interest. And in so doing, because of where he was with his tax bracket, he was going to be below the threshold for paying any capital gains. So he went from something that was probably a 15% plus, 18 with California was probably closer to 26 or so percent capital gains tax, to paying an estimated 0 capital gains tax. I have another guy who is in another state who is got an investment property. He's a younger person, single. He's looking to sell his investment property and quit. He's just kind of said, I've been running 100 miles an hour for about 10 years now. He says, or 15 years. I just want to take some of my money, leave my 401k where it is. And apparently you can live in Portugal for royalty for about $2,500 a month as an expatriate. He says he knows a lot of people that does it. He sort of speaks the language, wants to move over there. And so he's looking to do this, and he's able to do it in such a way that he'll receive this his property, his capital gains over time, and the income from the sale of the property over time, he too is anticipating he won't have to pay any capital gains taxes on this. So it's really pretty exciting when you can help some folks. It doesn't have to be these multi-million-dollar deals. I've talked with somebody in wine country not long ago that was selling a business and is interested in, since ended up going back to a lease agreement, but when they're ready to sell, they love the idea. So when you get to talking to people and showing them, I've got some proprietary analytical tools that I help people make the most informed decisions about this. And it's really nice when they can see what can happen. The key is just really finding out about it early enough. One thing I always fail to mention, there's no cost to the buyer or seller for this, by the way. Whatever the parties agree to, whatever price they agree to, that entire amount that they choose to defer goes to the life insurance company, goes directly to the life insurance company, and the life insurance company pays us to facilitate that business. So you don't get a bill from us. We don't send you an invoice saying this is what you'll have to pay us. The funds just go directly to the life insurance company, and then they agree to make these future payments to the seller.
Now, California, but you're able to facilitate these settlements, these structured sales anywhere in the country?
Yes, I'm licensed pretty much everywhere. I think there are a few states in 30 years I hadn't had any activity, and I let my license lapse, but I don't anticipate having. But I'm probably licensed in probably like 46 or 47 states across the country, and not all transactions qualify. Every case is unique, so you want to make sure you get this pre-evaluated to make sure that it does qualify. Most investment properties are going to qualify. Most single-family residences are going to qualify if they have money above that exemption threshold. But yeah, we can do this, and most of the stuff, with DocuSign and we're doing this via Zoom. Most of the time, face-to-face meetings aren't necessary anymore for our part.
Well, initially, when I read your article a while back, I thought, this could come into play for somebody that's inherited property.
Yes.
Through a probate, or also this could be a way to, set up your kid's college education. Defer, and then you can take those. You could take those installments and use them for college.
Time it with that. Now, it's important to note that when you receive the funds in the future, they are still going to be subject to whatever the prevailing capital gains rates are. But as I explained in those couple examples, they're still technically subject to capital gains taxes, but they fall below the threshold. So they owe taxes, but because they're in the zero tax bracket, they don't have to pay taxes, or because they're in the 15%. And you mentioned the tax brackets. It's just kind of, you hate to read the tea leaves because we're always wrong. Nobody can predict the future, but my sense is that the target on the capital gains is probably on the way higher ends, not the ones that are maybe not even the 1 to 3 million or less. It's the 10 to 20 million and above are the ones that they're probably really want to go after. This particular Congress is my guess.
I agree with that. Well, I think this has been a very interesting discussion tonight. I know we just briefly went over most of the details. I appreciate you being on with us tonight, Dan, and I encourage anybody to. We're going to put your contact information up. This will be wherever you found it on Facebook tonight. You'll always be able to go back and see it. Eventually, it will get loaded up on YouTube, and you'll be able to come back and see Dan's contact information. Shoot me a phone call or an email, and I'll get you in touch with Dan. And Dan, I hope you have a good night, and I appreciate you sharing your knowledge with us tonight.
Thanks much, Terry. I really appreciate it. It's great talking with you. All the best to you going forward. Have yourself a good rest of the year. Happy summer and everything else.
Sounds good, Dan. We'll talk to you soon.
Okay, take care. Thanks for having me. Bye-bye.